This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
Mega media deal. The nation's largest cable operator, Comcast, wants to get even bigger. It plans to buy number 2, Time Warner Cable. Why? What does it mean for consumers? And what will the regulators say?
Frozen spending. Shoppers stayed home last month, causing retail sales to drop, a key measure of economic activity. How much is due to the weather, and is it cause for concern? And Cisco skids. Shares slump as the maker of networking gear faces fresh questions over whether its turnaround strategy is working. All that and more tonight on Nightly Business Report for Thursday, February 13th. Good evening, everybody. I'm Tyler Matheson. And Susie Garrett has the night off. She does. So I'm welcome in for Susie. Thank you. We begin this evening with a mega merger in the media world, a $45 billion deal that would combine the nation's 2 largest cable TV providers, Comcast and Time Warner Cable. Now, if approved, the company would have 33 million customers, nearly 1 out of every 3 cable households in the U.S., and become a dominant force in creating and delivering TV content. The all-stock offer would give Time Warner Cable shareholders nearly $159 a share, pretty big premium over the stock's closing price today of $144.81. Julia Borston has more on today's deal, what it means to both companies, and what it could mean for cable customers.
Comcast's acquisition of Time Warner Cable, if it's approved, would create a cable and broadband internet giant with nationwide reach. Comcast saying the deal will pay off and start generating money in year 1, in part because it'll have operating efficiencies of $1.5 billion.
Comcast buying Time Warner Cable gives them a huge nationwide footprint to increase competition, gives them significant scale to roll out broadband, increase broadband adoption, and obviously provide a much better product for the average American consumer.
But consumer concerns will be under the microscope when the FCC evaluates the deal. Consumer advocacy group Free Press rejecting the deal, warning in a statement that, quote, Comcast will have unprecedented market power over consumers and an unprecedented ability to exert its influence over any channels or businesses that want to reach Comcast customers. But Comcast says the deal will not affect consumer options.
We don't compete. We're not in the same markets. We're not in any of the same zip codes with Time Warner. There is no overlap. There's no reduction of competition. So we're just able to bring better products to their markets.
Comcast says a merger will actually benefit consumers and small and medium-sized businesses, providing faster internet connections and better technology for streaming video.
There's over 4, in many cases, 5 video competitors in every market, selling all of the content services. The business is transforming every day with technology. It's a competitive business.
Another question, how the combined company's greater leverage will impact negotiations with content companies like CBS, which battled with Time Warner Cable over fees for months last year.
We don't think it's going to be the same sort of struggle. We obviously already have an existing deal with Comcast, and we look forward to continuing that in the future.
Now we'll see whether the deal can clear regulatory hurdles. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And let's turn now to those regulatory hurdles Julia just mentioned. Hampton Pearson joins us from Washington with more. So what are, Hampton, the possible roadblocks to the deal, and what hurdles does it have to overcome?
Well, first of all, the Justice Department is going to review the proposals for basically harms to competition, some of which Julia touched on in her report. While Comcast and Time Warner have no overlap in their respective cable businesses, that merged company would see Comcast with about 30 million households just in cable TV alone. It's also being argued that the company would have leverage with the content providers when it comes to distribution. Comcast, of course, owns NBC Universal, but what about major content providers like CBS and Disney? Would the merged Comcast Time Warner have too much leverage, if you will, as far as future negotiations in things like retransmission deals. Also, that merged company would put Comcast in 19 of the 20 largest markets with about a 30% share of the pay TV business and also a strong position for providing broadband and internet services as well. Comcast, of course, argues its real competition in all those venues is satellite TV and telecom, not just other cable providers. And we've seen, by the way, the Justice Antitrust Division stepping up its scrutiny of big merger deals lately.
Right.
And the other thing, too, the piece that the Federal Communications Commission is going to have to review is all those things related to the public interest, from whether cable bills would get jacked up, and it is the first new deal for the new FCC Commissioner, Tom Wheeler. Consumer groups, as you heard again in Julia's report, already predicting higher prices.
And then there's Congress, Hampton. What role, if any, might Congress play in this?
Well, no surprise, there will be hearings in both the House and Senate within hours of the news today about this deal. We had bipartisan statements from the leaders of the antitrust subcommittees in both the House and Senate announcing plans to evaluate the benefits and the challenges of this proposed merger going forward. Also, if there's anything there's a consensus about in all of this, is that the deal will be closely scrutinized by regulators and probably could take about a year before we get some sort of final resolution.
All right, Hampton, thank you very much. Hampton Pearson reporting from Washington. And a disclosure, Comcast is the parent company of CNBC, which produces this program.
On Wall Street, the major averages ended with some modest gains today. Strong earnings reports from the likes of Goodyear, PepsiCo, and Burger King helped offset disappointing data about retail sales in January and a spike in first-time jobless claims last week. The Dow finished up 63 points today and closing back above the 16,000 threshold. The Nasdaq was up 39 points, a nearly 1% jump, and its sixth session in a row of gains. And the S&P was up 10.
More now on that weaker than forecast retail sales number from last month, with Mother Nature getting a lot of the blame. The Commerce Department reports that unusually frigid temps in January sent overall retail sales 0.4% lower, with Americans spending less, most notably on autos, new clothing, and maybe not surprisingly, dining out.
This week's winter storm, called Pax, stretching from Louisiana to Maine, is already having a big impact on retail sales for February. Sarah Eisen takes a look at how this latest winter blast is impacting some of the nation's biggest retailers, the consumer, and the economy.
The winter storm is paralyzing retail in parts of the country. Some color from corporate America. Walmart had to close 137 facilities in Alabama, Georgia, the Carolinas, and Virginia, including some supercenters and Sam's Clubs. Walmart told us our biggest challenge right now is staffing. 125 Macy's stores either shut down or delayed opening today, including 11 Bloomingdale's from North Carolina through New Jersey. Home Depot closed 70 stores yesterday, primarily around its Atlanta headquarters. All but 3 reopened this morning.
I think this too will pass. I mean, I think it's gonna clear within a couple of days. I think that it affects some business. This part of the year isn't the biggest, and I think they'll get through this, and the people will have cabin fever and be out and shopping in the next couple of days.
So how does it impact the economy? We got a clue today from those retail sales numbers for January slipping 0.4%. Industries that rely on foot traffic, auto sales, clothing, furniture stores, and restaurants led the declines.
Some of the larger retailers probably got more affected. I still think that some of the retailers that had really good key items probably performed fairly well. We saw that out of Dick's Sporting Goods that just comped a 7 for the quarter ending January, and I would believe that they are still benefiting from having the cold weather product.
While 2 straight months of declining sales likely reflected frigid temperatures, there were some signs of weakness creeping in. For instance, in January, online sales also came in negative. We're going to have to wait until the weather improves to get a real read on consumer spending, but for now, it looks like it's in a deep freeze. For Nightly Business Report, I'm Sarah Eisen.
All this crippling cold and snowy weather is sending supplies of natural gas lower and the price sharply higher. Futures on natural gas shot up 8% today to a more than 10-month high.
And a new survey says that same wicked winter weather is taking a $50 billion toll on the economy this quarter, with half of recent economic weakness attributed to those frigid temps and dangerous snow and ice. Goldman Sachs even lowered its estimate for first quarter economic growth to 1.6%, down from a previous forecast of 2.6%.
Our guest tonight, Bill Smead, says every year has its GDP ups and downs, but he remains optimistic about the economy and the markets for the long term. He's CEO and Chief Investment Officer at Smead Capital Management. Bill, welcome back. Good to have you with us. Let's talk a little bit about the economy and how weather may affect it here in the first quarter. I was at a conference a couple of days ago where everybody was saying, expect some real lumpiness, bumpiness in some of the numbers, and they won't really be trustworthy in the first quarter. What do you think?
Well, that could be accurate. There's things like this in individual quarters that happen almost every year. A few years ago, the federal government was such a net drag on GDP because of the way they were having to rein in employees and rein in spending, that was a real drag. And so we had a few, in 2010, 2011, 2012, we had 3 different stages of worrying about double-dip recession and so forth. It's just a bump in the road. I don't know how many people have extrapolated all the extra babies that we might have 9 months from now. The last time New York City had a brownout, I think they had a record-setting number of babies, and these storms are trapping people indoors, and so you just don't know. But the irony is, the way the market's traded, it has had an impact because they feel like the QE is not going to get sped up, and a lot of people participate in this market under the assumption that the only thing going for it is the Fed. So when they feel good about the Fed, they buy stocks, and when they get nervous about the economy being strong enough to not need the Fed, they back away.
You do maintain, Bill, though, do you not, that basically large cap U.S. stocks are under-owned by some of the wealthiest investors out there, and perhaps the average investor as well?
Yeah, for example, Harvard's endowment was in a major publication over the weekend explaining to people that they have 11% of their $30+ billion portfolio in U.S. long-only equity. And we know from studies like the Nakubo Common Fund of endowments that 52% in long U.S. equity was average for institutions back, say, in 2002. So the idea that you can have a wicked, vicious bear market and massive sell-off usually means to sell off, you had to be on, and we think the largest pools of money in the world, especially U.S. institutions, aren't on. Therefore, it's hard for them to get off. In the meantime, speculators could do to get their ears pinned back because there's been a lot of frothy activity.
You have identified several S&P sectors that you like, and several that you really don't, including energy, basic materials, industrials, utilities, and telecom. Those are largely defensive sectors. So I assume you're in technology, you're in medical, you're in consumer discretionary. Am I right?
Well, you're on the right track. We're actually fairly lightly involved in technology through eBay and Accenture, who are basically technology agnostic. So our biggest overweights are consumer discretionary, which has been a very contrary and lonely trade. We've been overweighted there for 5 years, and financials and healthcare. It's really easy to think about our portfolio. There's 86 million Americans between 18 and 37, and we think they're going to come out of the deep freeze of the 5-year engagement and start living their lives. So that means a lot of economic growth engine from buying houses, cars, et cetera. So we're very positive longer term about the economy. And secondarily, my group, the baby boomers, we want to provide all the medicine that I'm going to need for the next 30 years to deal with my chronic illnesses.
All right, very, very quickly, got 30 seconds. Is the correction over, or is there going to be another one?
Well, no, we think it's a corrective phase that could last as long as 6 months.
Okay, great. Bill, thank you very much. We appreciate your time tonight. Bill Smead with Smead Capital Management.
Thank you.
And still ahead, shares of Cisco sliding. Is the tech company's turnaround plan in trouble?
Shares of Cisco, by far the biggest decliner in the Dow today. They fell 2.5% after yesterday's disappointing profit report and 2014 forecast. That's got some industry watchers questioning Cisco's turnaround plans. Our Josh Lipton has more.
We will look at it not just from a growth perspective.
It was a tough quarter for Cisco's CEO, John Chambers. The company suffered a nearly 8% drop in sales, and only 3 of its 9 business segments showed growth. Cisco didn't give investors much reason to cheer, predicting that revenue would decline again in the current quarter. Cisco is seen as a tech bellwether. The company makes equipment that directs data traffic across the internet. Analysts covering Cisco say a number of factors contributed to Cisco's disappointing financial results. There are some challenges out of Cisco's control, such as a weak global IT spending environment, which is plodding along in the low single digits. On the conference call with analysts, Chambers talked about the weakness he's seen specifically in the emerging markets, such as Brazil, Russia, India, and China. But there are also issues specific for Cisco. The company has overhauled key products in its core businesses of switching and routing. Customers have been stepping back and evaluating whether they want to buy these new products. Investors sold Cisco shares today, discouraged by the results, but bulls say the stock is cheap and they're optimistic that Cisco will ultimately get some traction with its new products.
Cisco has the best arsenal in terms of the product portfolio. They have the best experience in terms of navigating prior market transitions, and they have the most flexibility when it comes to the balance sheet.
There are also questions about Chambers, a source of tension among Cisco investors. His fans say he's grown the company from $2 billion in annual revenue to more than $48 billion since Chambers became CEO in January 1995. That stock is up 1,000%, more than the major indexes. But in the past 10 years, the stock is down nearly 10%, way underperforming the market. Chambers has indicated that he could step down as CEO as soon as this year. Posse thinks a transition in the C-suite within that time frame would make sense for the company.
He's got a long, credible history with the company. I think he's indicated it's probably time for him in the next couple of years to hand over the reins, and I'm comfortable with that sort of a time frame.
Chambers and his team have a clear plan for Cisco, stay very active when it comes to M&A, invest a lot in research and development, and keep buying back stock from shareholders. Time will tell if that's enough to win over investors. Josh Lipton, Nightly Business Report, Silicon Valley.
AIG swings to a profit, showing continued signs of a turnaround since a government bailout. And that is where we begin tonight's market focus. The insurer's earnings out after the closing bell beat on both the top and the bottom line. The company also upped its quarterly dividend and increased its buyback program by $1 billion. Shares initially rose after hours. The stock ended the regular session up 1% to $49.59. Kraft Foods also reported after the market close. Profits rose on pension-related gains and on higher sales of refrigerated meals and beverages. Revenue missed just slightly, but investors didn't seem to mind. Shares rose following the report, with Kraft ending the regular day up a fraction to $53.60. And UPS announced a 5-cent increase to its dividend. The company said its solid cash flow performance drove the decision to give more back to shareholders. Since the year 2000, the company's dividend has tripled. Shares were up slightly to $96.56. And PepsiCo's North American beverage business posted another drop in sales, but the company says it won't spin off that unit despite pressure from an activist investor. The soda and snack maker managed to report an earnings beat on strong sales from its snack food division, and it raised the amount of cash that it will give back to shareholders. The CFO is optimistic about the future growth.
We're becoming more and more efficient while we're driving the top line, and we're freeing up money to invest in innovation and to invest in our brands. So we really do have a dynamic cycle working in the company right now, which is what makes the performance so heartening, because we think it could continue for quite a period of time.
Well, revenue, though, came in shy of estimates, which sent the shares down more than 2% to $79.69. Ty?
Well, Sue, Merck may get more than $10 billion for its consumer business, that according to reports. The drug maker has been publicly exploring the sale of the unit, which makes well-known brands like Coppertone sunscreen, Claritin allergy pills, among other things. Merck is looking to shed the business to focus on its therapeutic areas, like its drugs for cancer and diabetes. Shares rose a fraction today to $55.10. J.C. Penney named former Kohl's executive Ed Record as its new chief financial officer. The struggling retailer didn't say why its current CFO, Kevin Hanna, is leaving, but the change, which will go into effect in March, is the latest in a series of turnaround efforts by the troubled department store operator. Shares of JCP higher today by a little bit to $5.99. And Whole Foods lowered its 2014 sales and profit forecast. The natural foods grocer reported an earnings miss after last night's closing bell. It blamed it on growing competition from traditional grocers who are offering more organic foods. The co-CEO, Walter Robb, says quality is what makes his chain successful.
Obviously, this quarter was disappointing for us as well, too. But I think, look, we're not just about price and competing. We're also about quality and the highest quality standards in the supermarket industry. And so it's balance between value and quality. And I think we make our way forward based on both of those, not just on price.
Still, shares did fall more than 7% today to $51.46.
Another train derailment with heavy Canadian crude oil spilling into a rural Pennsylvania community. That's escalating calls for stronger safety standards on the nation's freight rails. 21 tankers from a 120-car Norfolk Southern train went off the tracks at a bend in the town of Vandergrift, Pennsylvania. 19 tankers held crude, 2 others carried propane. Despite heavy snow, the cleanup is underway, and thankfully there were no reports of injury or fire.
An auto recall to tell you about. General Motors is recalling 778,000 Chevy Cobalts from the years 2005 through 07. The automaker says putting heavy items on keychains can pull down on the ignition and shut the engine off. So here's the recommendation, folks. Leave the bowling ball in the trunk. Do not put it on the keychain. And coming up, municipal budgets are already stretched thin, and now they may soon be facing yet another unexpected cost. That story when we come right back.
If you or someone you know is flying anywhere today, be prepared to wait a lot. FlightAware.com reports that a staggering 6,700 flights were canceled today because of the latest snowstorm. That's a new one-day record. The hardest hit airports: Baltimore, Washington Reagan National in D.C., and Charlotte Douglas in North Carolina, with each seeing more than 80% of today's scheduled flights grounded.
We'll talk about offering the right product at the right time. Generac, the maker of portable generators and standby power systems that so many homeowners bought after recent blizzards and hurricanes knocked out electricity. Generac earned $1.11 a share last quarter, easily beating estimates of 90 cents and wrapping up its third straight year of record revenue. Investors really warmed up to the stock, igniting shares more than 13% today. It was up $6.75.
Well, while many snowbound homeowners may rest easy knowing that they have generators, some towns and cities are finding themselves short on salt, road salt that is, and without a key material that'll keep its streets safe and open this winter. Morgan Brennan has more on the next big expense that a lot of municipalities may be facing.
If you drive, you probably already know the feeling. The toll that all this wicked winter weather's been taking on the roads, causing an outbreak of potholes from the Midwest to the Northeast. As storms keep coming, cities and towns are adding road repair, and with it more asphalt and higher labor costs, to a growing list of weather-related expenses. Municipal budgets are already stretched thin thanks to road salt shortages, record propane prices, and an unprecedented number of water main breaks, which have helped make more potholes. In New Jersey, the Transportation Department patched more than 25,000 potholes in January alone. That's more than double the number filled a year ago. In New York City, the DOT filled nearly 69,000 potholes in the first 6 weeks of 2014, 83% more than the same period last year. And in the Midwest, Chicago has already patched more than 125,000 potholes this year. And St. Paul, Minnesota's city engineer says the winter is shaping up to be one of the worst he's ever seen, thanks to heavy plowing and extreme cold. All of this as business leaders and union officials urge Congress to hike spending on infrastructure, funding projects that have been deferred in recent years.
The DOT says that a third of our roads are now in poor or mediocre condition. We need, as a nation, to say we're going to be the most competitive when it comes to infrastructure and understand that that investment today is going to reap tremendous benefits down the road.
Still, there's one silver lining for municipal coffers. The asphalt market is depressed. Thanks to a lack of construction since the economic downturn, demand has remained 2/3 what it was in 2007, and prices are pretty much flat. Experts say pothole patching will do little to drive down supplies or push prices higher, so it's one less shortage for cities to worry about. Even so, local officials say they won't know the full extent of the damage until the weather gets warmer. That's when they decide which streets to patch versus which ones to rebuild, which can get very expensive. For Nightly Business Report, I'm Morgan Brennan.
I'm getting ready for the ride home already. All right, finally tonight, as residents of 22 states dig out from upwards of 18 inches of fresh snow, another part of the country, the Mojave Desert, saw the world's biggest solar energy farm open for business today. The $2.2 billion solar electric generating system, stretching across 5 square miles of federal land on the California-Nevada border, has been transformed by hundreds of thousands of solar panels, enough to power 140,000 homes. The power generators are owned by NRG Energy, Bright Source Energy, and Google. So let the sunshine in. Sue?
Wouldn't that be nice?
Wouldn't that be nice?
You ready to dig out your car?
I got to go dig it out when I get home.
We both have to.
I was getting ready to leave today, and they plowed me back in. I was so...
Spring's almost here. I hope. That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody, no matter where you are. We'll see you tomorrow. Happy Valentine's Day, meantime.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Tyler Mathisen with a Nightly Business Report news brief. A $45 billion mega merger would combine the nation's 2 largest cable TV providers, Comcast, the owner of CNBC, which produces Nightly Business Report, and Time Warner Cable. If approved by regulators, the company would have 33 million customers, nearly 1 out of every 3 cable households in the U.S. On Wall Street, some solid earnings reports helped offset a spike in first-time jobless claims last week and disappointing retail sales in January, with crippling cold weather getting much of the blame. The Dow up 63 points, closing back above the 16,000 threshold. The Nasdaq was up 39 points. Its 6th session in a row of gains, in the S&P added 10. A record 6,700 flights were canceled today because of snow and ice in the east. And tune in to Nightly Business Report here on your public television station.